So here's a question. Why do so many financial experts, the big names, the academics, why do they keep pushing for this really simple investing approach? Just using index funds.
Yeah, it does seem a bit plain, doesn't it? Especially when you hear all the buzz about finding the next big stock or using complex strategies.
Exactly. It feels like you should be doing more.
But when you actually look at the numbers, the long-term results, the case for simple indexing gets, well, incredibly strong. It really comes down to basic math.
And that math is what we're digging into today. We're looking at some key ideas from John Bogle's really important work, Common Sense on Mutual Funds. He's the Vanguard founder, right? The guy who created the first index fund for regular investors.
That's him. And his whole argument isn't just like a nice theory. It's built on decades of market data.
Yeah.
He focuses hard on the things you, the investor, can actually manage.
Okay, so our plan for this deep dive is to unpack that core argument. Why low-cost passive investing? We want to pull out the key insights from Bogle's work, the stuff that really hits home if you're looking for a strategy that's straightforward and, actually works over time. All right, let's get into it.
Okay, so the absolute number one point, the thing that practically jumps off the page in Bogle's writing, is costs. It sounds almost too simple, but costs matter hugely.
Right, like, okay, fees are bad, we get it. But is it really that big a deal?
It absolutely is. The data Bogle uses shows how even seemingly tiny costs just snowball over the years and eat away at your returns. We're talking the obvious stuff, like the expense ratio,
Yeah.
that percentage fee they charge every year,
Uh-huh.
but also the less obvious things. Transaction costs from all the buying and selling managers do, and taxes that trading generates.
Okay, yeah.
Bogle points out the average stock mutual fund might charge around 1% a year just for management fees and other operating costs. Doesn't sound like much, maybe.
1%. Yeah, seems small.
But compound that 1% over, say, 20 or 30 years. It can take a massive bite out of your final nest egg. He calls it the tyranny of compounding costs. It works against you relentlessly.
And he compares this directly to index funds in the source material, right?
Exactly. The comparison is pretty stark. A typical actively managed fund might have that 1% expense ratio, maybe more. An index fund just tracking the market, its cost could be like 0.2% or even lower these days.
Wow, okay.
That difference, let's say 0.8%, might not seem dramatic year to year, but it's like giving the index fund a head start in the race every single year, and that advantage compounds.
Is there an example in the book?
Yeah, there's a good one. Imagine you invest $10,000 for 15 years. Let's say the market return allows the index fund, after its tiny cost, to earn 7.8% a year.
Okay.
And the managed fund, after its higher costs, earns only 6%. The index fund grows to roughly $30,900.
And the managed fund?
Only about $24,000.
Whoa, that's almost a $7,000 difference, just from cost, not even from bad stock picks in that scenario, just the fee drag.
Precisely. It shows how an index fund tends to capture almost all of the market's return each year, maybe 99%. Over the long haul, you get very close to the market's total accumulated growth.
Whereas the active fund?
The average active fund, because of costs, might only capture, say, 87% of the return annually. Over many years, that could mean you only end up with maybe 70% of the growth the market actually delivered. Costs are a huge hurdle.
And it's not just the expense ratio, you mentioned trading costs.
Right. Active funds trade a lot. Buying, selling. Bogle estimated those trading costs, commissions, and market impact could easily add another 0.8% drag per transaction. If a fund turns over its whole portfolio in a year, 100% turnover, that's potentially another 1.6% cost on top of the expense ratio.
Ouch. And that trading probably creates taxable gains for the investor too, right?
Austin, yes. Another layer of cost friction. It all adds up, and it explains why the data consistently shows most active funds don't beat their simple market benchmark index like the S&P 500 over the long term.
The book cites some pretty big names acknowledging this, doesn't it?
Yeah, even legendary managers like Peter Lynch are quoted saying most people are better off in an index fund. Schwab's data showed maybe only 1 in 4 active funds actually outperformed. The odds just aren't great.
So, beyond costs, what else does Bogle emphasize in these excerpts?
Simplicity and patience. He really argues against chasing performance, trying to pick next year's winning fund, or timing the market. The evidence suggests that's mostly a loser's game and a costly one.
And simpler is often less risky too.
In a way, yes. An index fund holds everything, so you're diversified across the whole market. You avoid the risk of one manager making a bad concentrated bet or one stock imploding. You just own the market.
Okay, so let's pull this together. We've seen how focusing on keeping costs super low with index funds can make a really big difference over time.
Yeah, a profound difference, and how just passively tracking the market often means you actually keep more of the market's return compared to trying to beat it actively.
And the value of just sticking to a simple plan, being patient, not chasing things.
Hmm.
So this does raise an important question.
Mm.
What does this really mean for you listening right now? The material seems to argue pretty strongly that choosing between active and passive isn't just about fun performance charts. It's maybe more about maximizing your actual take-home return after all those costs and taxes bite.
And simplifying the whole process too, just accepting the market's return instead of fighting it.
So here's the final thought to leave you with. If all this evidence Bogle presents, and that others have confirmed, strongly suggests that the average active fund consistently fails to beat its benchmark after costs.
Despite having smart, dedicated professionals running them.
Right. Does that make the whole idea of trying to pick winning stocks or winning fund managers, does that make it an inherently uphill battle? Maybe even a game that's kind of stacked against the individual investor from the start?